How do doctors who accept medical insurance make money? From the viewpoint of a consultant in designing, developing and maintaining medical practices, many successful medical practices today are structured around the basis of accepting medical insurances. In addition, the use of databases and structural querying of the variables of the revenue cycle establishes the benchmarks for achieving successful operation as well as meeting expectations of the owners, operators. Achieving a level of acceptable profitability really depends on the realistic goals of the owners, operators. The fixed costs of the medical practice can be easily determined. Fixed expenses include items such as rent, mortgage, utilities, front office staff, back office staff, materials and supplies, maintenance and services, etc. The variable is the patient population and its impact on revenue. The usual and customary reimbursement for many procedures are known. If one wishes to calculate a minimum baseline revenue, practice revenue, the Medicare RBRVS allowance values are published annually. More sophistication might utilize the patient billing databases and refine the baseline revenue value by calculating income by fiscal class i.e., type of coverage and services rendered. The difference that is calculated between the costs of the practice and patient income represents the draw for the owner-operators. They, themselves, have professional expenses that are normally excluded from the practice draw. Since they are also equal partners in the venture, a consensus is usually reached in the size of the partnership draw plus a redistribution model for the profit. Since the income of all U.S. medical practices are to a very large extent dependent on insurance payments, and this includes Medicare and Medicaid, as well as contracts and grants from governments viz. Emergency medicine, almost all survive, and many of them are non-profit and not-for-profit businesses. The secret is to formulate a budget and follow it, adjusting for variances.